To say that it's been an interesting time in the market is an understatement. As of this morning at about 11 o'clock, as I'm recording this video, the market's whipsawed. It was up, it's been down, it's kind of all over the place on rumors. What I wanted to do today was jump on here to give you my thoughts, ideas, what we should be doing. And of course, I want to go over 3 charts, which I'm going to jump into rather quickly. I'm going to give you the charts. Here's kind of a quick outline. I'm going to give you the charts first to kind of build the narrative on what's going on and to put this into perspective, because I know this seems like an event where it's one of a kind and this has never happened before and the market's never going to go back up. What essentially I'm going to do is I'm going to talk about the market and the impact of the market. I'm not going to spend too much time on tariffs. I'm sure you feel like you're in economics class with all the different tariffs, reciprocal tariffs, different countries and things like that, because I'm sure the news and everything that we've been watching and reading is going to do a better job at explaining the tariffs and the policies, and I will. So here we go. We're going to jump into chart 1 right now, which gives us an overview, which puts things into perspective from an historical standpoint. So when we're looking at this chart here from an historical standpoint, it gives us an idea of all major events that have happened and really what that means for the market. And more importantly, what we're looking at when we're looking at major events, we're looking at all these different things that are happening on this chart here. I guess the point is we don't know what the next major event is going to be, whether it's political, whether it's a war, whether it's policies, have major events. We didn't foresee a pandemic coming, but we had a pandemic and the market went down crazy amounts in a very quick period of time. But then the market roar back in less than 30 days to kind of make up everything that we've lost. When we're talking about investing and building and constructing portfolios, the reason why we have our portfolios constructed the way we do, we're not just looking at investing in stocks where we have a combination of stocks and bonds. And for a lot of you, one of our more popular portfolios is 60% stocks and 40% bonds. And the reason why we have 40% invested in bonds is because of market turmoil, volatility in times like this. The 40% in bonds is more of a volatility dampener to help reduce the volatility and allow us to stay invested during times like this. So that is the reason why we have the portfolios constructed the way that we do. Well, again, we don't know the next major event that's going to happen, but we do know that it's going to happen. So that's chart 1. I want to now jump into chart 2. So chart 2 here, what we're going over is just market corrections and recoveries. I'm not going to spend too much time on this because you can kind of see what's going on here, but the market falls an average of 14% during the average correction. So I think going all the way back to World War II, we've had 30 different market corrections and recoveries. And we're entering into a bear market phase where we are right now. What does that mean? Well, it means that the S&P 500 specifically and the NASDAQ, it's 20%. It's a 20% drop from its most recent high. And this morning we entered bear market territory on the S&P. We've hit bear market territory on the NASDAQ. From a technical standpoint, everything is trading well below the magical 200-day moving average, and really nothing good happens below the 200-day moving average. You get crazy moves and whipsaws like we're seeing. But what this chart is showing us here is that the S&P 500 total return since World War II, market corrections and peak to trough declines of 10 to 20%. And again, you see all these crazy lines going on, but we've had about 30 of them. We're going to have more. There's going to be something in 3 years or 4 years that we would have never thought of that puts this much pressure on the market. So again, markets fall 14% and it takes about 4 months for it to recover. While I know when we're in an event and a period like this where there's extreme market volatility, it seems like there's no way that we're ever going to recover in 4 months, but on the average, that's what happens. Okay, so now here's chart 3. And very simply, this is why we talk about timing the market. Yes, can you time the market on the downside to some degree by following technical analysis on a short-term period of time? Yes, you can do that more effectively than trying to time when to get back into the market. That is the key. So you've heard me talk about this before to many of you, but during 2008, we went out of the market and we looked like heroes and we were great and it was awesome. But the problem is what this chart is saying is when you're not invested during the best days, here's a hypothetical growth of $10,000 invested in the S&P 500 going all the way back to 1980. If you stayed invested during everything that went on, you'd have about 1.8 million. If you missed only the 5 best days, just the 5 best days of the market, it drops you down to 671. If you missed the 10 best days, 43, and so on and so forth, you can see from the chart. So what does this mean? Well, what this means is that timing the market on the way out is a little bit easier, okay? But timing it on the way in is the hardest part because you don't know when you're going to have these bear market rallies. Okay, so that's chart 3. Enough with the charts. I hope you found it helpful, but I like to use charts because it gives me a framework and a picture of what's going on. But what should we do? Well, here's what we should do. Do nothing. I know you're going to say, Joe, but that's not doing anything. Well, it is. Doing nothing is actually doing something. You're making an educated academic decision not to panic and sell at the worst possible time. Because if we sell now and try to, let's say we sold out of stocks and bought treasuries, yeah, it'll make people feel better. But what we're doing is we're selling at a 20% down from the highs. We're ensuring that we're basically ensuring we're going to lose money, right? Because when we feel awful, we want to sell. When we feel great, we want to buy. And what happens in the market when we feel awful and want to sell? The market goes down. And what happens when we want to buy? We feel amazing because the markets went up. So all we're doing is ensuring we're buying high and selling low, which doesn't really work to make money. My job is to help you make money. So I want to buy low and sell high. So really, when you have these events, if you have money on the sideline, you should be thinking about now is the time to purchase, now's the time to jump in. I'm not saying everyone should do that, and it sounds crazy to some people, but the really good investors like the Warren Buffett and things like that, they look at these as opportunities to kind of jump in. So we have good asset allocations, we have great funds, great expenses. None of that has changed fundamentally from an academic framework of what we're doing from an investing standpoint. Yeah, there's stuff going on in the market that's causing a correction. The market's been heated up since basically 2022. We've gone up. Multiples are high. Valuations are high. Inflation, all these different things coming into play, which is causing this. I hope you found this helpful. As always, if you have any questions, want to talk about this further, text me, call me, email me. I'm here. Whatever you need, whatever we need to talk about, as much as we need to talk about it, it's fine. That's why I'm here. It's Monday. I know some pizza places are closed, but I'm sure you can find a good pizza place to go get some pizza. And like a bunch of my clients actually emailed me on Friday, pizza always makes bad things feel better. So have some pizza, feel better. And until next time, I'll see everyone. But again, any questions, any concerns, call, email, text. See everybody later.